There's almost none.
Really?
Really. I invested in notes all through the 80s and 90s, and when they dried up, I started doing hard money lending. Because they were very similar returns. And you needed to know the same information.
Can you talk about a little bit about the pros and cons of investing in like non-performing paper, performing paper, and hard money lending or private lending like that, and what the kind of the differences are between those, and as far as workload goes and possible risk?
Okay, I have to give that to him because workload. When you spoke workload,
Yeah.
I don't know what that word. Well, it can be negotiated. Hard money goes anywhere from what, 6 to 15. Where's Ryder?
He just
left?
Yeah.
He left.
Hey, hard money lender, I gave him the business. Who else is hard money lender? So what are they going right now? Yeah, just talk about it.
It depends on where you're at.
Depends on what area of the country. You know, when I get hard money, I want it to be rather called private money than hard money, because I want the lower interest rates.
There you go.
He's smiling because
Hard money makes it hard to make a profit. So
yes.
Here's the thing. So out here in California right now, I'm seeing hard money rates at 8.5% to 9%, possibly up to 10 or 11, depending on 12, depending on who you're at. But I'm seeing the competitive rates at 8.5 and 9, and plus 2 points is what I'm seeing at a minimum on those 8.5. Usually, if you're at like a 12% rate, you might be able to get like a point or something like that involved. But you know, out of state, in certain Midwest areas, because the loan size is smaller, you can get a little bit better rates than that, you know? But it depends also who you're dealing with. Like if I'm going to go through and raise capital, and I've been doing this for 10 plus years and have a lot of capital sources, I'm going to pay 8. I don't need the money if it's 10, 12%. I just don't need it because I have enough relationships. But the newer people that might be more risky when you're dealing with, you know, note investing, that might not have as much experience, and so it's a little bit more risky from that regard. You're dealing with, you know, you can charge a little bit higher rates, and you should, because your risk is different, you know. So it all depends, and it also depends on the loan to value. If you have something that's 75% loan to value versus 50% loan to value, that might constitute a completely different rate, and it also may be dependent on if you're performing or not performing at that time or something like that. Like non-performing paper, like we've invested in before, and you can make really high returns, but you can imagine the amount of work that goes into that, of course, that Gerald does as well, you know, and how much you're getting paid for your labor as well. So you have to kind of look at it too, saying, is there a passive investment return that I'm comfortable with? And then is there an active investment return that I'm comfortable with? Because if you're doing the work, you should get paid more for those types of things.
And let me add, where's the money coming from? Is it somebody who has a pension or self-directed IRA fund, or it's just sitting there and they're getting absolutely no return on their money? Or if it's in a bank account and they're getting less than 1%, if you can offer them a safe, good return, they'd probably be willing to accept 4 to 6%.
Gerald, how many paper cuts did you get? Because it sounds like you do so much work, but you don't look like someone who does a lot of work. No,
I don't get paper cuts anymore. There's this thing called direct deposit.
I'm talking to this guy. You give him a hard time. I don't think you work that hard.
I was just in his office. He was working.
Gerald, how many paper cuts? Because some of us have jobs, and some of us may go out and actually like bust concrete, so you may be a breath of fresh air.
Bless you.
Yeah,
Everybody goes out and busts concrete.
Well, you know, we run a small office. I have 5 employees, and my wife is a CPA, so I have to give homage to the CPA people out here tonight. So I'm indirectly related, you know. But it's a lot of work. I mean, putting this last bid together, you know, a lot of questions, all of our due diligence, you know, going through all these loans, negotiating back and forth. You know, we have an active note investing company. We've done probably close to 1,000 deals since 2008. So we've churned through a lot of notes. And currently we still hold over 300, and we're buying 30 this week, so we're adding 10% to our portfolio. And our rate of return, I would think, is in the high teens, you know, 16, 18%. And I pay investors, you know, I basically have 2 ways of investing. One is through the joint ventures, the JVs, The other way is on a fixed rate of return, where I'll give someone, the lowest money I'm getting right now is about 6.5%, and the highest is up in the, I hate to say it, but I am paying 12% to some people because they've been with me a long time, and they're like,
They have a lot of capital to bring to the table.
yeah, and they're
stuff
good
like that.
friends of mine. I'm paying money to their IRA account. They'll do the same for me someday, you know. And they're like, well, Gerald, you gave me 12 last time. How come I can't get 12 again? You know, that kind of a thing.
But you gotta get your negotiating down.
Well,
The margins are getting thinner. I can't do anything about it.
I ratcheted down. You know, I have paid. I hate to say it, but I paid 18% at one time. You know, 4 or 5 years ago when I was kind of hungry for money at that time. But where was I going?
Did you make money?
What's the?
Yeah. I mean, we're making money. I mean, you know, one of your questions was talk about a deal that we've done recently.
Yeah.
I'm going to use 2 examples. One, I had a package of performing loans that I basically packaged up and used them as collateral. I got $350,000 from an investor. I'm paying them 10%. We're doing interest only for 5 years with a balloon at the end of that period that is extendable. So at the end of 5 years, if she says, hey, I don't have any place to put that money, let's go another year or 2 years, whatever. And I'm happy with that deal. I packaged up a pool of performing loans. We put them into a title holding trust. They're secured, or we're both beneficiaries of the trust. I'm the trustee. I get to sign all the documents whenever we have to do a transaction related to that trust. But that's one deal I've done recently. Another deal, real quickly, I bought a third mortgage on a property in Irvine for $35,000. Most of the loans that we buy are institutional. They were originated by a bank like Wells Fargo or Chase or B of A. This loan was a private loan where two people had loaned money. And it's like one person loaned money to her friend, and her friend quit paying her. This loan was done in 2007. I sent out a lot of letters, like 5,000 letters last year, soliciting, you know, hey, I'd like to buy your note. And she responded to that letter, so I bought her a note for $35,000. It was a $100,000 note, and the total amount owed was $180,000. I contacted the homeowner. She paid for a while, and then she quit paying, and she also quit paying her first mortgage. And it was a big, expensive house in Irvine, $2.5 million house. So we foreclosed on the property. I paid her $25,000 cash for keys to move out. We ended up taking the house, selling it, and I got a check for $342,000 at the end of that escrow. I had $90,000 invested in it. So we made a $250,000 on that one deal this year. It was in April. But it was hairy. I mean, there's a lot of hair on that deal. You know, the first mortgage started foreclosure in January on that deal. It was $170,000 to bring the loan current. You know, the payments were $10,500 a month on that deal. So there was an IRS lien on the property. So I had to wait 120 days. There's what's called a right of redemption period. So I couldn't close escrow until that IRS lien dropped off the property. I also wiped out a judgment for $600,000 on that property. So when I foreclosed on it, I wiped out $1.2 million of debt that was junior to me. So, you know, when we foreclosed on it, we were in third position. So we had about $2 million of debt in front of us that we were basically responsible for. But there was, you know, a lot of equity in the property as well. So that was a home run. It was better than average. You know, you're not going to hit those kind of deals on a regular basis. But we've had probably 3 or 4 like that since I started doing this business.
And that's what's key, is in that situation specifically, when you're buying a junior lien like that to someone else's lien, look how important it is to make sure you understand what's getting paid or not. The people that were above him in that position did not get that. They got wiped out completely because of that. So, you know, those types of situations are really important, really to know, you know, who's getting paid, who's in default, and understand all of those things. Because if you don't, you can get in a really tough situation. The same thing with when it comes to, you know, different like property tax liens or, you know, IRS liens and things like that. They can come before you in a situation, and sometimes you have to come and pay those off or have the capital sources to do so to protect your investment if you really needed to, or catch them up on their mortgage. $10,500 a month with an IRS lien and a $600,000, I mean, you're not worried as much about the $600,000 lien as you are the IRS lien and things like that, but those are the things, he should have got paid for that with dealing with all that headache, you know? So there was a situation, it was really funny, when I first had just started meeting Gerald and talking with him at some of the FIBI clubs, I'm going to have to tell the story, yeah. So a friend of mine, she came to me and she kept getting notices in the mail because she had a second mortgage of like $100,000 and she wasn't paying and stuff like that and couldn't afford it. And then she brings it to me. I'm like, why didn't you bring this to me months ago? They're starting to foreclose on you now and things like that. They're about to foreclose. And so I look at it and I look down and look at the paperwork and it's from the Lemoyne Group, Gerald Lemoyne's company. Wow. So what was crazy about that is I was able to be like, look, take your head out of the sand. Let's get this cleaned up for you. Just go talk to Gerald about it. And I called him immediately. I'm like, you're not going to believe this. And he's like, I've been trying to deal with this person for months. They've been knocking on the door, sending people by the house, and I can't get a hold of them. There's a Mercedes in the driveway, which happened to be their boyfriend's car, not the person that was doing this. And it was funny because we were able to work a deal like $35,000 for a $100,000 note. He probably got it for $10,000 or $20,000 and made some profit on it, and was able to pay off this $35,000 loan that was $100,000, and him make a profit and have a win-win with everybody. But it comes down to, you know, communicating with these people, so you can see the type of stuff that he's had to go through when something comes non-performing, how much work you have to do to get that. You know, he was like, I'm ready to foreclose, I can't get a hold of them, they're just sticking their head in the sand because they're scared, and they don't know what to do. And this happens probably constantly with a non-performing note business. They just will not get in touch with you because they think you're the evil bank that's going to foreclose, and they just don't want to talk to you. You know, when in reality, when you're dealing with someone like Gerald that's an individual, you have the opportunity to switch things up and make a payment or come up with a monthly payment, you know? So, you know, it's really interesting the types of things that you have to do in this note business to actually get things performing.
What's the difference in the rate of return between a performing and non-performing note?
Depends on what you get it for, but...
What's the typical, like?
I'll just speak real quickly,
Sure.
Then Bill can jump in. I bought a note today, and it's in like Studio City, and it pays $1,500 a month, and I'm paying $60,000 for it. It's an $80,000 balance. I'm paying $60,000 for it, so it's a 30% return on a performing note with a consistent pay history. But that's unusual. I bought some other performing notes a few months ago, and I was getting them for 15 to 18%. But they're junior liens, they're second mortgages. And that same tape, the ones that I bought had protective equity. There was another guy that was bidding on the same loans, and he was willing to pay more money than me for some of the loans that didn't have enough equity. He was kind of disregarding equity in this equation, and I wasn't. You know, to me, if I have to foreclose on that property, I want to make sure that I've got enough, you know, where I can get my money out of the deal at least. So he got part of the notes. I mean, it was a pool of like maybe 40 loans. He bought 10 of them, and I bought 30 of them. And I was not willing to pay as much as him on the loans that had no equity. But he was just disregarding the equity side of the equation, which to me is kind of silly. But on performing first mortgages, you know, you're more likely in the 8 or 10% range. Okay. You know, 7, 8, 9, 10%. On the junior liens, you might get a little higher. You might be in the 10 to 12% range typically.
Okay. And what's the difference in the workload between a performing and a...
Well, if it's a performing loan, there's no difference in the workload. You just, you know, deposit the check in the bank every month.
That's the difference.
That's the difference.
Or get automatic deposit.
I mean, non-performing and performing?
Yeah.
Oh, yeah, it's a huge difference. I mean, the non-performing loans are like buying a house that needs rehab. It's like buying an ugly house. You know, I buy ugly notes that need a lot of work. And I might buy some notes that I sit on for 3, 4, 5 years and don't collect on because I'm waiting for equity to rise. And sometimes I'll buy notes with delinquent first mortgages. You know, their first mortgage might not have been paid in 6 months or a year. And I'm hoping that the homeowner will get a modification on that loan and bring it current, which happens a lot. The banks are they bend over backwards to help the homeowner nowadays get a modification done and get that loan performing again. You know, the government is kind of on their backs about, you know, give these homeowners a break, kind of a thing.
So, and what percentage of your notes are non-performing on an average?
We probably, I mean, we buy, probably 80% of the loans that we buy are non-performing and 20% performing. Because anybody can buy a performing note. It doesn't take much expertise. I mean, I don't mean that in a bad way. But, you know, it's like, do you want to buy a house off the MLS that's all pretty and shiny and, you know, doesn't need any work? Or do you want to buy a beat-up old REO or you want to go down to the trustee sale and buy a foreclosure house where you've got to evict the homeowner and rehab the property? You know, me buying non-performing notes is more like the people that go down to the trustee sales and buy houses in foreclosure.
Because you don't know what you're getting.
Yeah.
You don't know what you're getting. You're taking all the risk. That's why I can buy these notes for 15 or 20 cents on the dollar.
Where do you go to find these deals at 15 or 20 cents?
That's the hard part. You know, people know me, and I get referrals a lot. I go to a lot of note conferences. I just spent last weekend at the Distressed Mortgage Expo over in Huntington.
You're speaking over there, right?
I was on a panel, yeah. And then I go to the Paper Source in April every year, and you know, I go to 5 or 6 conferences a year and meet people.
Is there an
network.
auction system for notes, or is there like a website where you can go bid on it?
Not really, not really. FCI has a few notes on it.
Jasmine has a platform for non-performing paper and stuff like that.
1400 on there.
Yeah, maybe, you know, most of my deals are negotiated. You know, like on this one that we're closing on this week, I was the only bidder on both of those deals. You know, so we're spending $400,000, and I had no competition.
That's amazing.
As long as I hit as long as I hit the seller's target price, you know, they have in their mind, hey, I want to get, you know, $150,000 for this pool of notes.
And that's really where it comes in too, right? You know, you're asking about the returns and things like that. It all depends on what the pain point of the seller is. Like you could have a performing note that the person it's a private lender or something, totally performing. They just need their money back immediately for another need. It's like when you're going and doing direct mail and pay-by-click marketing for homeowners, you know, on the ground to try to buy their property, it's because they're in distress in some way, shape, or form. Even if it's performing or something like that, you're trying to pick those up. Same type of thing for note holders, the people, the owners of those notes. But then now you have institutional money as well that's coming in and doing that.
And then there's another way to do things. We like to solve problems. We're both problem solvers. And the amount of money we make is determined by the quality of the problems we solve, not the quantity. Well, he's really more in quantity now. I'm more in quality. I do smaller things. I can get a very nice return on first. He's talking about 8, I can get 15 and more. I do it a little differently. Are you aware that you do not have to buy all of a note at one time? You can buy some of the payments. It's called partial. And that's what I specialize in. It's making a comeback, actually. I did it all through the 90s, and it was a vast majority of my business, where I buy just some of the payments, because sometimes lenders need cash. They've lent the money out, they're getting income and cash need. So I subtly market to lenders who already made loans and ask them if they could use some cash right now. And then I buy the next few payments on their note, which is in first position. And I buy it in such a way that I get a 15%, 24% return on my money. And they're happy many times because if it's amortized, they're not quite so happy if it's interest only.
There's a lot of cool things you can do too. I mean,
Oh yeah.
I mean, it's interesting. Like I just did a private loan to a flipper and was able to do it at 12% a point. Okay, and I did it for $225,000, and I borrowed $175 of it at 8%. This is the one Bill helped me with the other day as far as.
That's called hypothecation.
Yeah, hypothecating the note. And so what I did is I gave them an assignment deed of trust to protect their $175,000, and I'm in it for $50,000. So guess what the return on investment is? Because I'm making 12% a point on the entire thing and paying 8 on 175. On my $50,000, I'm making a 35% return. And my loan to value was at 65%. My investor's loan to value was less than almost, I think it was like 50. I can't do the math right now. But it's really interesting. Just by doing that, my investor is ridiculously protected. But the key to using other people's money is to know how the paperwork works and know how to protect them. You cannot use anybody else's money without making sure that everything is clean, you know, everyone's protected, involved, and they know the paperwork, and you can teach them how that paperwork works. Because if you can't teach them how the paperwork works, you're never going to convince them to loan to you in the first place, because you're not able to educate them enough on that for them to be comfortable.
May I tell a story?
Yes.
I know he's heard the story. I still do it, though not as often. Back in the 80s, there was a company called Imperial Savings. And if you're old enough, you would have heard of them. You're in the South Bay area, primarily. And I dealt with the office that was in El Segundo. I would approach people, direct mail, like he did, and offer to buy their $100,000 note for $70,000. They had an immediate need for $70,000. So they would sell me this note that had a face amount of $100,000 that they were going to receive payments for maybe 30 years. They're scheduled to receive payments. I would then go to Imperial Savings and say, how much will you loan against this $100,000 note? Here are all the details of it. And they would lend me $80,000 on that note. And they would handle the sale and the loan, and they would then send the borrower the statements every month. So they handled the whole thing. So I paid 70, they gave me 80. What did I do with the $10,000? Difference. There was a difference, right?
You went on vacation?
No, I put it in Hip National Bank.
There you go. There you go.
And then later on, okay, the borrower owed how much? $100,000. When that got refinanced a few years later, they paid off the $100,000. How much did Imperial Savings get? 80. 80, because they lent 80. Where'd that extra $20,000 go? Hib National Bank. How much money came out of my pocket? Nothing. I did 46 of those deals with Imperial Savings. So I cried when they closed their doors. Now, they can still be done. Matthew just did one, right? I still do them too. It's hypothecating, it's borrowing against an existing note. And sometimes I borrow the money to buy the note. So it can be done. Another example, because I think we're running out of time. A deal that I have done several times. And this goes toward like what Carlos likes to do. I like to approach somebody who's older, who has been in a house a long time, and is getting to the point where they're not going to be able to stay in the house any longer. Are those people out there? Yes. And I would approach them, and for example, I will buy the house. This particular house had been lived in 30 years. It had not had any repairs or anything done for probably the last 20 years. And so there was a lot of deferred maintenance, and basically the carpet was still shag carpet in there. The husband had passed away, the wife was still in there. I helped the wife find a place to go to, assisted care facility. I bought the house, because I did that for her, I bought the house for $0 down. No money in my pocket, I bought it for $360,000, I bought it for $1,000 a month for 360 payments. What was my interest rate? Zero. Okay. Now, it needed a lot of work. We're talking $50,000 to $80,000 work. Was I going to do the work? No. So I flipped the property. I sold it to a family who I knew was looking to rent in the area, but they had 3 boys and they had 4 St. Bernards. Were they going to be able to rent a house? No. And this guy made $100,000. He'd lived in the area. They moved out when they were able to move up. And then they struggled as long as they could. They eventually lost the house. They wanted to come back to the neighborhood. So I sold it to them for $400,000, which was a great deal for them. If I fixed it up and sold it, probably would have sold it for about $500,000, $520,000. Could have done that. I didn't want to do that. There's some tax implications that I wanted to avoid. So I flipped this house with almost nothing down for $400,000. And I created a second note, which included the first. So they made payments to me, I made payments to the first. Were they going to be able to buy a house on those kind of terms anywhere else?
No.
Were they? No. I knew this guy was handy with his hands because he worked in construction. The deal was for his down payment, he was going to fix up the house. Specifically things to fix up the house, like replace the roof, everything.
Contract.
It was in the agreement, and he had a time frame to do it, to do the things. He did all of them. So I paid out $1,000. I'm getting from him almost $3,500. So that was a nice return. Is that nice income? There was a whipped cream on top.
Yeah, the second you created.
Huh?
You created the second, right?
Right. Well, when the first runs out, my second will still be going for another 10 years.
Yep.
I had a structure that it was going to be 40 years at 8%. So that when the first was, if it went 30 years, first paid off, they would still owe me $180,000.
Yep.
Awesome.
And that's nice. What's even nicer is, because I put the deal together, I put them in it, I get 25% of the improved value.
So you
And
did
now-
an equity sharing loan in that case? Is that what you're looking
Well, I
at?
took an option
Okay.
for 25% of the ownership after 10 years.
That's amazing.
And last time I heard the property was worth $900,000.
There's people that I know that do nothing but that strategy. They go buy properties and fix up for discounts. They go resell them for a profit with 100% seller financing or 5-10% down, get it refinanced and out there consistently. I've done this multiple times. You have to be careful when you're dealing with homeowner loans, specifically because of Dodd-Frank and SAFE Act and things like that in those markets and what laws happen in that state. But it happens a lot in the Midwest markets when you have a really high rent-to-price ratio where, we did one to a tenant that put 5% down. She's been in the property for 3 years, not missing a single payment, but wasn't going to qualify because of previous credit history or lack of income. She was self-employed in a side job to help her save on taxes, and so wasn't going to qualify, traditionally. And so I was able to do, 5% down financing where her monthly payment is equal to her rent amount, including the taxes and insurance, and I impounded the accounts, and she was the most thankful person in the world because she could actually own a house. And she was living there, wasn't planning on moving, and now she has ownership. I gave her a 30-year fixed rate loan on the thing at 9%. So, and that's where the rent-to-price ratio was. But, I did it for $85,000 with $5,000 down, and I was in it for $60,000. So look at what my return on investment is on that. It's huge comparatively. I'm in the high teens because of that. So if you look at those strategies, now I can go hypothecate the note as well and borrow 6 or 8% at $60,000 for my cost, and I'm in it for nothing.
Hypothecate me, you just dropped the bomb and then.
So yeah.
Actually, we discussed it while you were gone.
Yeah, he mentioned it.
Yes, we did.
Just basically selling a piece of your note or using it as collateral for another note, basically. So, does that make sense, guys? So, and Jasmine has a note school, so if you guys actually want to buy things from her platform, she requires you to go to the note school, which I think is probably genius because you don't want to do the wrong thing, and you want to learn the paperwork involved, and that's I learned this from, I think it was Dykes Bodford and I forget the other guy's name that was there, but it wasn't Peter. I hadn't seen him at that time, but I forget the guy's name, but it was a weekend course. You were there, but it was years ago now, and I went for a weekend course, spent $600 for a weekend course, it changed my entire sales strategy. I was working with a lot of Japanese clients that couldn't get U.S. financing, and it taught me exactly how to do seller financing on these things. And all the paperwork involved. I brought in a consultant as well to help me with the paperwork on the first ones, and after that it was you know, you learn and learn and learn and keep moving forward. And so those strategies are absolutely amazing, and so many people don't even fix up the property. They're like, buy it, sell it to somebody with a markup that is going to actually do all the work and finance homeowners. And they're actually building your equity for you as they renovate that property, so you're even in it for less money. So it's really interesting, all the strategies you can deploy.
And I wanted to add on the deal that I just described to you. My second did not conform to Dodd-Frank. I didn't care, because I had them sign this thing in their own handwriting that said, we understand that we buy, because I had an underwriter check to see if they qualified for the loan. We don't qualify for this loan, and we may lose the house. We want to go ahead with it.
Mm-hmm.
And they signed and dated it. That was my way around up front,
Okay.
in their handwriting.
How? Go ahead, Joe.
Bill was talking about partials, and I've been, the way that I've used a lot of partials. I've probably done 50 partial agreements over the last few years, and what I've used it for is to raise capital, where I buy a performing loan. I had one recently where, not recently, a few years ago, I was getting in $500 a month, and I found a guy that wanted, he had like $25,000 to invest, and he was willing to take 8%. So I sold off the front end of a loan. I had a loan that was paying me $510 a month for 20 years, 240 months. I sold off the front end of the loan, which is 60 payments at $500 a month, for $25,000. I had bought the loan for $25,000.
Nice.
So basically I had no cash in the deal at that point. So I could take that 25 and go back and buy another loan and repeat the same process over and over again. Does everyone understand what I'm saying about that?
And after 5 years, it's 100% your profit, and that person's paid off, basically,
Exactly.
right? So
After 5 years, and I get the full $500 a month. So I've done that over and over again. Not so much lately, but in the beginning. The other way that I've used partials, this is something I did a few months ago, or 6 months ago. I had a second mortgage on a property in like Solano Beach, Del Mar area.
That's where I live.
Yeah, nice area. Property had, $500,000 equity over my second mortgage. I bought a performing second mortgage. It was $150,000 face value, interest only, with a balloon payment at 5 years later. I bought it. She wanted to sell it quick, and so I got a 25% discount on it. I bought it for like $112,500, I think, if I remember the numbers correctly. And the payment coming in is about $1,500 a month. So if you figure 12% interest rate on $150,000 a year loan balance, it's about $18,000 a year divided by 12 is $1,500. So I found someone. So my return at that discounted rate is like 16 or 17%, something like that. So I found someone who had $75,000 in their IRA account, and they were happy to get 9.5% on it. So I sold off half of the loan for $75,000, and I'm paying them $600 a month. So I had $37,500 invested in the deal. Take the $112,500 minus $75,000 leaves $37,500. That's what I had invested in the deal. And I'm getting $900 a month on that. $1,500 minus the $600 I'm paying out to the other person gives me $900 on a $37,000 investment. So it's about a 30% return.
that's all.
So I sold off half of the loan at a lower interest rate, 9.5%. And I'm getting, a higher return on my share of the investment. Everyone follow that?
How do you deal with the paperwork?
I do it a little differently than Bill. I put it into a title holding trust, and I made the two of us beneficiaries of the trust. And I just wrote up an agreement that spells out the terms of the loan. I call it a security agreement. It just says, I'm going to pay you this much money for this length of time. And at the end of this, it's an interest-only payment for 5 years. So I get $75,000 when this guy pays us off for 5 years, and the investor gets his $75,000 back also.
Question?
Yeah, how do you deal with bankruptcy? You know, because that's what a lot of people think when, you know, you hear that you buy the asset and then they go bankrupt and you lose all your money, you know, that's
not necessarily
right, no,
the
I mean,
case.
how you guys deal with that scenario when you're buying a,
Go
you
to
know,
bankruptcy court, have a trustee,
Right.
The trustee.
and has to get the property set aside.
So it's not as horrific as you hear sometimes about the bankruptcies wiping you out.
It
and
can be
things like that.
horrific, because right now, recently I got lien stripped.
right, that's what I'm saying, how do you guys deal
Even
with the
though-
first and the second?
Even though there was lots of equity in the property.
Is that a
Is this
second
been
or first?
notified you, or?
There was something going on between the trustee and the
Was it the first or
bankruptcy
second?
court.
Was it the first or second?
I was the first that got stripped.
No, what happened? The bankruptcy?
Yeah, that's what I kept saying.
You know, I have a lot of experience with bankruptcy. I deal with it every week. I'm dealing with a bankruptcy.
Right.
And some of these loans I buy that I pay, you know, low amounts of money for, I realize that I may get stripped. One of the things that I do is I just don't foreclose on them. I just don't push too hard on the collection side of things. You know, I'll buy these loans at a big discount, stick them in a file cabinet, and I'll pull them out and look at them once every 6 months or so and see, hey, is there any equity yet? You know, if not, then I just put it back in the file cabinet and let it sit there. But, you know, a lot of times when I go to foreclose on a property, the homeowner will go and file bankruptcy. It's just a stalling tactic. It just slows down the process. I get my bankruptcy attorney.
Because that's the advice they get nowadays.
Yeah. I had a guy, I bought a note on a property down in San Clemente, and he filed bankruptcy 4 times. You know, he filed Chapter 13, then his wife filed Chapter 13, then he filed Chapter 11, then his wife filed Chapter 11. So it drug out the process.
Chapter 48.
It took me like 10 months to get this guy out of the house, you know, to finally foreclose and evict. But it just comes with the business, and that's not the typical case. Usually they file bankruptcy once, and we get it dismissed, and we go to trustee sale and finish up the deal. Or they come to us and negotiate and say, you know, hey, I want to keep my house. Can we work this out? So, but we deal with bankruptcy all the time. It just slows down the process in most cases.
It's just the cost of doing business.
Yes. It's a pain in the ass.
Lisa,
I think it's interesting because there's so many strategies with this no business. We just
like in real estate.
Yeah,
So
just
many
like
niches.
if you can bring different strategies and ideas to the table, there's no limit to how much money you can make in this. We just did one where we bought a house on a lake that there was no other comps right in like 2009 or 10, and there was no comps, so the bank let it go to us for cheap. We're into the property for about $95,000 for a 4,000 square foot house on a lake out in Tennessee that was worth about $180,000 at that point. And it's interesting because we just held it for the cash flow. And then, just recently, we went and resold it to a homeowner that basically we have all this equity in it. And one of my investors in this case had a traditional bank loan on the property. They left that bank loan in place and did a wraparound mortgage and reseller financed it and left that financing in place to do so. Now, and we did a $170,000 sale, so she got a little bit of a discount on the property because she was already living in it. We would have probably had to put $10,000 into the property anyways in order to actually really sell it on the open market. And so what's interesting in that situation is most people would be afraid of the due on sale clause in this situation, right? You can't sell a property without to someone else and leave the loan in place without violating the due on sale clause. Now, the due on sale clause states that the bank has the right to call that loan due. They don't have the obligation to. They have the right to if you don't notify them. But if you notify them, they're going to call it due. So what you do in that case is you better make sure if you ever do that type of thing that you have backup money to be able to pay that off if something was to happen. You know, so in that situation, if you think about we're borrowing, you know, the $90,000 and my other investor involved in this transaction didn't want to pay the tax on that much of a gain and to sell in an open market as well. So now she's able to do an installment sale on that deal. And I'm a 50-50 partner with her on that, and do an installment sale on that deal. And I have the backup money to be able to pay it off if something was to happen. And but we're using 4.75% money on that too. I mean, the return on investment is phenomenal. We're making like 30% plus. It's crazy. So and that's just utilizing your credit or different situations to actually do this. But be careful. Make sure you understand that due on sale clause. Make sure you have the financial backing or someone that could take you out if you get into a pinch, in a situation like that. So, so you guys, go ahead.
I'd like to offer something.
Yes.
Question number 7 says, what is the primary due diligence you do when purchasing a note? If people will email me, bill@bill10investments.com, I will email you back a documentation checklist that I use.
Awesome.
We used to be able to post files on Meetup, no longer, so that's put it this way.
Great. No problem at all. And if you guys, need that as well, or forget Bill's information, hit me up and I'll make sure you guys get it as well. So, because we're looking at a possible market change or the peaking of a market in certain segments of the U.S. or a lot of the segments of the U.S., is there anything you guys are taking into consideration when you're trying to buy these notes to try to mitigate the risk of a downturn, or different investing that you're doing a little bit differently now to try to realize, hey, in the next 5 years or something, we could have a major crash? Are you guys investing in different markets that aren't as volatile? Are you guys finding that you need to have a little bit more equity to protect yourself from that downside risk? Or is it more like the percentages type game that you're talking about? Is there ways that you guys have seen to protect yourself in the past during previous downturns that you may want to enact now, or for anybody in the group that might want to look at now to protect themselves better?
The way I buy notes, I'm buying with a great deal of equity in the property and someone who pays their obligations. So I'm not worried if it goes down, because they'll continue making that payment.
That emotional equity that you're talking about. Okay.
Is it Andrew? Yeah. I see an opportunity in that one of the things I'm looking at, and I attempt to do things nearby, Southern California. I'm getting lazy, I admit it. And the opportunity right now I see is in commercial notes. And I'm looking at commercial notes. Commercial notes are different. I will do commercial notes in other parts of the country because they are usually larger. And it's a totally different thing. Before you get into that, you have to know more information than even buying regular residential notes, because there's no motion, almost no motion in commercial notes. And right now there's a lot of resets going on in the commercial finance field. A lot of companies are not able to pay, so you notice there's a lot of, at least I've seen there's a lot of retail space for lease now, all over the place. So commercial notes they're not going to be able to pay off their commercial notes. I see foreclosure down the line. I see opportunity right now.
What are some of the main differences that you can think of between residential notes and commercial that you would probably want to look out for if you're trying to buy commercial paper, or what?
Well, I'd like office condos. Really like office condos, because those are something that you can change the use very, very easily. I don't like big empty storage spaces unless I have a plan for, like, say the area doesn't have enough, what's that stuff called, storage? Self-storage.
Self-storage.
I could see that as a wonderful opportunity for these big vacant warehouses. I see that as a wonderful, because some of them are air conditioned, and so that's an opportunity there.
Remember, medical marijuana is legal as of January 1st, so you got grow houses all over the place.
I am a former medical probation officer. I'm going to stay away from it.
Yeah, wait till the feds come in and say they're okay with
I've
it.
seen results of that stuff from the other side. So
Yeah, I hear you.
there's a wonderful opportunity. It's something that personal choice.
Well, it's interesting. We're doing a panel in Manhattan Beach on that.
They can't get financing.
In January. So.
Matthew, they can't get financing. So
Well, yeah.
all that seller financing right now, or private money.
I did a deal that was 14% return on investment secured by a commercial building with no first mortgage. This was a first mortgage that was paying 14% in Colorado for that. But, you know, there's some risk to that, of course. You have to be careful about those types of things because of the federal government, you know, regulations that can come down. So, you know, there's all kinds of new things coming out now
Well, they're
that you
also
can put
very,
notes against.
commercial's very economy determined.
Right, right, absolutely.
They determine if.
You have a lot more volatility
Yes, thank you.
with those types of things, right? No emotional equity in that, so.
Emotional equity.
Question here.
No, I was going to say the Supreme Court upheld the Rohrabacher-Farr amendment, which says that if it's legal in the state to grow it, the feds can't come down and close it down. So the Supreme Court. Huh?
Actually, that's not true anymore. They can actually use
Yes.
banks. They just can't get financing.
Right.
So they're going to be, because.
That's why there's the opportunity. You
Right,
can't get
right,
financing.
exactly, so. But that's interesting, absolutely, and we have an attorney coming in to talk about that later on, so it should be really interesting. But there's so many new opportunities out there that new changes in technology are gonna bring to the table that are gonna just change the game substantially with all new information coming to the table, new efficiencies and things like that. It's really interesting. Have you guys seen any?
Marijuana notes are gonna become for sale soon.
Yeah, probably. So, are you guys seeing anything with regard to technology that might be changing the game in the note industry
Oh,
at
they
all?
changed it. Technology changed the note industry completely.
Okay.
When I got started, it was the wild, wild west.
Okay,
Now, you can go on the internet. Now you can go on the internet and find out about notes. Before, there was no marketplace at all that you could go to.
interesting.
And I loved it. That's why I said I got into no business a long time ago, because nobody else was doing it, nobody else understood it. And until 1997, it was absolutely wonderful.
And even
It's been a little more difficult since then, but still wonderful.
even though a lot more people are in it now, I think there's still a vast majority of people that don't understand it in comparison to real estate in general and other asset classes, because they just don't know how to read legal documents. You know, that's what it comes down to.
Oh, so true of that, but niches, they don't understand that there's many niches in the note business as there are in real estate. They have creative techniques and strategies for real estate, work on notes and other things.
How did you discover it?
Discover what?
How did you get into this?
The note business?
Yeah.
Because I did real estate before the note business.
Right.
Because of real estate, I got into the note business.
You're tired of dealing with tenants, huh?
I invested out of state.
Too.
I invested out of state, and I had trouble keeping tenants. And so I got to a point where I got tired of traveling to solve problems. So I sold my properties, and a few of the properties. And I could only sell it by becoming the bank, by financing the sale myself. So I provide seller financing to get rid of my headache. Well, I didn't have any tenants towards the turnover anymore. The worst thing I did was having the cut fingers opening up the envelopes with the checks. And I go, wow. I went to real estate clubs and I told my colleagues about it. And they started doing it too, because they were having problems themselves, because we've been sold a bill of goods on another part of the country that
It's tough.
if we had a capable team on the ground to help us, we would have done well. But back then I didn't know better. So they did it also. They started selling their properties. They would be offered seller financing. They came back, they said they were doing that. And then after a couple months, I'm only getting a couple $100 a month. I really need some cash. So I started buying their notes from them at less than face value because I had some money. And then a few years later, I was friggin' brilliant. I just can't believe how brilliant I was because they all paid off. And then I go, wow, this is wonderful. So what the heck did I just do? So I started taking classes. And I remember I took this one class, and if you can ever find his product, his name is John Bailey, B-E-H-L-E. I took a 7-day course from him on the note business, as a business. And it was like taking a sip out of a fire hose. However, it jumped my business. I became a note investor, note broker, and I understood it. And then I started using investors' monies to buy notes. And then I started selling them to institutions. And then everybody knew that I was doing it, so I didn't have to market anymore. 99% of my business was referral business. And then in 1997, a terrible thing happened.
We got involved.
They all got refinanced out. We had a $5 million portfolio get paid off in 1 month, July 1997. Seriously.
I mean, it's good and bad. You get a bunch of money, but then all of a sudden you have
So
to
then
lose all
I
your
tried,
cash flow.
so then I started investing in mobile homes and mobile home notes. And then I said, the heck with this, and just started doing hard money lending and real estate from that. And then notes.
Question?
I have a question too, it's not related, but I would love to hear your opinion on it. What do you guys think about the program, there's only a few, but they allow you to borrow money, not private money, to buy debt. So there's guys that will give you hard money loans to buy debt. Do you think that's a good
I
idea?
mentioned that earlier, didn't I? Don't ever borrow money to buy an investment unless you
Even a
know
note?
what the heck you're doing.
Oh, so you would do it, you would borrow
I
money?
do it. Okay, I know what I'm doing. I've only had 30 years of scars and t-shirts.
Would you go to one of these companies, or you go to?
Oh, heck no. We're
That's
not
what I'm
doing
asking,
that.
'cause I feel like two companies pop
No,
up.
I would talk to people
Yeah.
like Sasha and, I can't remember, Zach, and I never saw your sister's name. Alana. I would attract people like that by
You go to a
speaking to
private
teachers.
person before you went to one of these things.
You always want to deal with a human being. You can speak to a human being. Okay. What they're doing is what another company did back in the 90s. They were called FINAC, First National Acceptance Corporation out of Michigan. They almost went under. They were a bank that almost went under because they did that. They created lines of credit for note brokers and note investors. And there was a downturn. And there had been a great deal of fraud, bad appraisals, and they almost went bad. I've seen it, and the people who got hurt worse were the people who
Leverage more.
leveraged more.
See, and that's the key right there is that if there's fraud involved and, bad appraisals and things like that, you better know how to value real estate. If you don't understand real estate, you have no business investing in notes at all. You need to understand the property first and how you can lose money from property. That's the most important thing.
I want to repeat this. A great investment is only great if you get paid.
There you go.
Sheep get sheared, hogs get slaughtered.
There you go.
You questioned about, what do we do in a downturn?
Yeah.
And I think you hit the nail on the head with this emotional equity. I mean, a homeowner's not sitting there thinking, oh, my house went down from 300 to 250. I better quit paying my mortgages. Most of them are going to keep paying their mortgages because they live in that house. They don't want to lose it. It's the ones that defaulted in this downturn like 2007 where people have these crazy loans. They go out in a speculative way. No income, no doc, stated income, all those types of loans. So and we invest in about 25 different states right now. So, and it's different being the bank in all those states as opposed to being a landlord in all those states. I would not recommend out-of-state landlording unless you have really good property management people, boots on the ground, and like Memphis. You're in Memphis.
I went through 5 management companies before starting my own. So,
Right.
Yeah.
You are the good property.
Yeah, I'm the only one that I think is efficient enough, in my opinion. I have a sister management company that's really, really, good. They run a lot and they're really efficient, but it took a lot, and it's like this in a lot of markets. They don't care. So unless you have some power, or unless you have some control in some way, I will never sign a management agreement that does not allow me an out if they're not acting in my best interest.
Right.
We'll never do it.
Also, throughout this country, if you're from California, you have a bullseye. on
Yeah,
your
you're
chest.
fresh meat. You're fresh meat. I actually went to the Memphis Investment Club meeting, and I was like, hey guys, I'm from California, I'm fresh meat. And, I was like, hey, I'm pitching a multifamily. I had like 4 or 5 people hit me up about it. And I actually got it sold there, but they were drooling. There like 15 people coming up to me. Here, I got properties. I got this. And you're like, yeah, I don't buy in the hood. Sorry,
I
thanks.
actually like the guys that run it.
Oh, yeah, they actually do a great job, in my opinion. They actually bring some quality information. They don't sell you a bunch of stuff, you know? They do a good job, you know, so, but I like that group. They let you go through and they do deal profile type stuff and things like that, so.
So, you know, for us, as being protected, we're in like 25 different states, so it's unlikely that, you know,
Cool.
Texas and Ohio and Florida are all going to crash at the same time. You know, there's some stability there, I think. And, you know, I just want to mention one thing that we do that I think is kind of cool. We use our junior mortgages. We foreclose from a second position, and we hold the property subject to. You know, we take over the payments on the first mortgage. So I just did this on a house in Mission Viejo. I didn't even have to foreclose. The lady was delinquent, and she knew she was going to lose her house. And she said, you know, Gerald, I'll just deed it over to you. Give me a few $1,000s to move out. So I gave her $5,000. Right now, the first mortgage is $635,000 at a 4 1/8% interest rate, and the house is probably worth $9,000, and I'm renting it for $3,600 a month. So we've been able to accumulate about $3 million worth of Southern California real estate by owning the junior lien, and then either doing a foreclosure or cash for keys with that homeowner and getting them out of the house and taking over the payments on the first mortgage. And, you know, hopefully we can leverage that, you know, as that portfolio, hopefully, you know, it'll increase in value over time. And right now it cash flows, so it pays for itself. You know, the tenants are paying all the mortgage payments.
I think the diversification thing is key for that, and understanding where you're investing and how volatile that market is when there's economic changes is something to really pay attention to as well, because if you're investing in a California market that's highly volatile in certain areas, you know, like you look at, you know, Riverside area went down by 50% during the crash. I don't think it necessarily went back up. Yeah, well, there's like 60 in certain cases and things like that, but if you're looking at those types of scenarios, you really want to see how much did that come back up to right now. Is it peaking again like it did last time? And is there a possibility that it could crash again? And so in that case, you want to kind of make sure you're extra protected in those highly volatile markets with additional equity. So if it goes down by 20%, you can get out. If it goes down by 30%, you can get out. If it goes down by 60%, you're pretty much screwed. But, you know, I don't know anybody who's going to fare well in that, unless nobody's going to want a 40% loan in the first place. So, you know, it doesn't make a whole lot of sense. So
I wanted to bring up, nobody brought it up, and he did it in a back way. Another way of investing in real estate is to buy a delinquent defaulted second to get the house. That's another way of getting into real estate. And you can do it sometimes for pennies on the dollar to start with. You just have to take it to the foreclosure.
it can actually be a better way to buy discounted properties now with the competition that's happening right now in the market, is to focus on that piece. Because like, you go to any property that needs fixed up in California right now, and everybody thinks it's worth market value, even if it's not, and they're trying to get that value from you. You go the note route, and you can buy the discounted note because banks are not in the foreclosure process, not in the, you know, property business, and so you can get them for much cheaper and get those discounts. So that being said, we're going to finish it up with that, and you know, remember guys, and I want you guys to definitely take a flyer from Bill for his group, which I know adds a lot of value to people. And Gerald, you have a group too, right, in Garden Grove?
Sure. If you go to the internet and look up Note Pros Workshop, it's a meetup group. If you just Google Note Pros, all one word, and then workshop. Andrew's been there. A few people in this room have been there. And get on the mailing list, and we'll email you out. Greg, is it Greg or Gary?
Yeah, Greg.
Yeah, he's been there a few times.
Okay.
We meet on the second Wednesday of the month, but I'm going to move that because I happen to be same night as Bill's meeting.
Same night as our meeting too. We happen to have the same night meeting. So in Manhattan Beach is ours, but you're in a different area, so that's
Well,
fine.
he agreed to move it because we're going to align. I'm going to tell everybody in my group, if you're interested in notes, as part of my group, go to his meeting.
Right, like a subgroup.
I'm going to call it like a subgroup. It's his own meeting, but we're going to call it a subgroup.
Where's yours at again?
Mine's up by Pasadena.
That's
Same
cool.
group.
Yeah, see, we're not competing. We're in Manhattan Beach. Nobody's going to drive
Actually,
that.
you're-
Sometimes.
Almost 20% of my group is from the South.
Interesting. That's, well,
And I get that complaint all the time that, Gerald, your meeting's the same night as Bill's meeting. We had to toss a coin as to which meeting to go to. I'd love to come to your meeting, but you conflict with Bill.
and then,
So-
Jasmine, you have a note school as well, correct? That
Well,
note lab, basically,
Yeah, we're
right?
doing a note lab, I actually have flyers, if you're interested, thanks for the plug, I was gonna ask you if you didn't mind, but, I'll give you flyers, it's in November, we only do them twice a year here, and I do, another 2 in New York, but that's it, you only get 4 out of me, so figure out which one you would come to. This is the last one for the year.
It's a weekend course, right?
Yeah, it's a 2-day,
Cool.
up here in Torrance.
Cool.
Do they talk funny in New York?
They do a lot of funny stuff.
Well, thank you guys very much. Feel free to check out meetup.com or For Investors by Investors. You'll find all of our different chapters on there. And go ahead and network. Find the people that you guys were supposed to be paying attention to earlier. None of you guys did it, did you? All right, thanks, guys.
All right, thanks.